Hi, everyone. Welcome. My name is Kristen Romaine, and I am the Director of Catalytic Philanthropy for Vertue Lab. And I want to welcome you all today to this panelist session on constructing clean portfolios for climate solutions. We are really excited to have such an incredible panel gathered for you today, and especially to be presenting with our partners at Croatan Institute. So I'm going to go ahead and introduce you to Christi Electris, who is the co-founder and fellow at Croatan Institute. Croatan is an independent nonprofit whose mission is to harness the power of investment for social good and ecological resilience. Christi helped to develop the Institute's total portfolio activation framework for understanding social and environmental impact investing across asset classes, and has been coordinating the Institute's Clean Portfolio Project, which takes a total portfolio approach to fossil-free investing in integrated climate solutions. She's led the Institute's recent research report, Divest, Invest, Philanthropy, 5 years after launch, and will guide us today in a conversation with 2 philanthropic foundations and 2 investment advisors on their experiences with fossil-free investing in climate solutions. Welcome, Christi, and thank you so much for being our partner and for leading this discussion. We're really excited to hear from the panelists today.
Thank you, Kristen, and thank you all of you for joining us today. I'm going to share my screen. Let's see here. We're a few slides, and then I'm excited to dive into a great conversation with the group here. Great. In this session, as Kristen just said, we're going to be talking about constructing clean portfolios for climate solutions. This is part of a kind of a series of events that the Clean Portfolio Project has been running since last year, and this one, the focus is mobilizing philanthropic capital across asset classes. We're really excited to be partnering with Vertue Lab to put this event on together. We'll have plenty of time for questions and discussion, so feel free to add your questions to the chat or the Q&A as we go along, and we'll try to get to as many as we can. I did want to put a quick note. We're going to be talking about investments, and it is a regulated industry, so we're here to educate and not to solicit. If you do hear about a product, you should do your own due diligence, and this is not investment advice. I'm going to do a quick overview of the Clean Portfolio Project and a little bit about the report that Kristen mentioned, and then we'll go around and talk with our panelists. So, the Clean Portfolio Project was originally born out of a collaboration with the impact investing community at SOCAP, or the Social Capital Markets Conference, in 2015. And the goal was to address early investor demand for opportunities and integrated solutions to climate change. We developed the first Divest Invest track of content at SOCAP, and then constructed a model portfolio called the Divest Invest Clean 15 that was designed specifically with institutional investors in mind, such as philanthropic foundations that had signed on to Divest Invest Philanthropy. Now, initial sponsors and partners included investment advisors, money managers, climate-related investment funds, as well as philanthropic funders. And since then, we've participated in the SOCAP conferences and held our own events. And this, as I mentioned, is part of a kind of an online and in-person at some point in the future series of events that we're trying to continue now. As I mentioned, we have a growing group of sponsors, and there are new opportunities to be involved in this phase. If this piques your interest, just get in touch with me. The first clean portfolio was the Divest Invest Clean 15 portfolio, and we're hoping to expand beyond that. But initially, it was 5 asset classes. We identified 15 strategies, so 3 in each of these asset classes: public equity, fixed income, private debt, private equity and venture capital, and real assets. The project aspires to add more asset classes such as cash, hedge funds, and infrastructure, and add additional strategies per asset class as well to be more diversified in its approach. So in January 2014, 17 foundations with nearly $1.8 billion in assets pledged to divest from fossil fuels and invest in climate solutions to climate change. And that was the launch of the Divest Invest Philanthropy Initiative. It has now grown to nearly 200 foundations and philanthropic family offices worth $24 billion. And what they've done is they've committed over 5 years to divest from oil, gas, and coal companies and invest in at least 5% of their assets in climate solutions such as renewable energy, energy efficiency, sustainable agriculture, community resilience, clean energy access for the developing world. And you know, philanthropy is just one arm of a global and growing movement. And right now there's more than 1,000 institutions with over $11 trillion as of last time it was counted last year, that have divested from fossil fuels for either ethical or financial reasons. And because 2019 marked the 5-year anniversary of Divest Invest Philanthropy, it provided a timely opportunity to take stock of the movement's progress among foundations. And we, the Divest Invest Philanthropy organization reached out to Croatan Institute to help run a study. We surveyed all foundations. We had about 60 participating in our survey, and we did some research to update the analysis. And so we found that 97% of the respondents that had pledged in 2014 at this point had held less than 1% of fossil fuels still in their portfolios while maintaining or improving their expected risk return profiles. Of the newer signatories that had not yet been in the pledge for 5 years, 89% had already divested from all of the carbon underground 200, which actually was the main commitment, and that means that they were ahead of ahead of schedule of their 5-year Divest Invest pledge. Most respondents said that their financial performance had been affected positively or neutrally, and that basically the results of the survey and the case studies established that philanthropy doesn't need to sacrifice value for values. So we were heartened to see that our understanding of the space was also what was actually being experienced by the foundations. So here I just wanted to tell you, show you the different themes that the respondents selected. 2/3 of all responding foundations indicated that 5% or more of their portfolios were invested in climate solutions at the time of the survey, and nearly half of the respondents had 10% or more invested in climate solutions. Because climate solutions can mean different things to different audiences, we asked them to respond to this list of themes. And so there may be some themes that were not included, but as you can see, renewable energy was on the top, followed by energy efficiency, but then sustainable food and agriculture has actually made it, you know, with regenerative agriculture being a large future area of our work for climate solutions. It's grown quite a bit. And then we had other topics such as clean energy access, green buildings, water, environmental finance, sustainable forestry, sustainable companies, and transportation, as well as the community resilience and just transition and/or just transition. 90% of respondents had divested from fossil fuels from 2 or more asset classes within their portfolio, which really means they've gone beyond the original pledge, which was to divest just from the carbon underground, which are public stocks and bonds. So they had gone beyond that, and in this case, we have public equity, venture capital, and private equity, private debt, fixed income, infrastructure, farmland, real estate, cash, hedge funds, and commodities. So with that brief overview of the work that we did kind of assessing the space last year, so that was about a year ago in October that we released that report, I'm now pleased to have a great panel here to join us on the discussion on how foundations are mobilizing their capital across asset classes into climate solutions. So Kathleen Simpson is the interim chief executive officer and chief financial officer of the Russell Family Foundation. And she collaborates with the board to guide the foundation's strategic planning, programs, and community affairs, and oversees the foundation's impact investing, finance, risk management, information technology, and operations. And the Russell Family Foundation was actually a generous supporter of the Divest Invest Philanthropy report that I mentioned as well. Brad Harrison is a managing director at Tiedemann Advisors, working primarily with foundations, endowments, and nonprofit organizations. He co-leads the firm's impact investing strategy and also designed and directly oversees the firm's environmental sustainability impact theme. Mike Lear is Senior Vice President and Private Wealth Advisor for Capital Group Private Client Services. He helps nonprofit foundations and endowments pursue their long-term financial objectives through effective planning and investment management, and also works directly with high net worth families and individuals. And Eric Lemelson He is a winery owner and president and founder of the Karuna Foundation, vice president and treasurer of the Lemelson Foundation, an environmental lawyer, climate change and energy policy activist. And we're really pleased to have this group here today to talk about the process of divesting, but more importantly, investing in clean climate solutions. So I'd like to turn now to my panelists and have each person have an opportunity to say a little bit more about what where you're coming from, and I'll start kind of in the order that we had on the slide. So I'll start with Kathleen.
Thank you, Christy. It's an honor to be part of this panel and to share back the journey that the Russell Family Foundation's been on. We were one of the initial signatories on the Divest Invest Pledge, so we're proud of the work that we've done in partnership with our investment advisor, Brad Harrison and Tiedemann Advisors. We at the Russell Family Foundation really believe in total portfolio activation and having this go across all of our asset classes. This total portfolio activation approach to our investment portfolio means that we use values-aligned ESG integration, thematic and catalytic investment approaches across all of our asset classes in a diversified, risk-managed strategy. We work to align our investments with the foundation's mission, and while we're also working to earn a market rate return. If you look at our portfolio, which we'll talk about a little bit later, over the last 5 years, we've moved substantially to total portfolio activation. And as of last month, we're just about at 90% of total impact across our asset classes, which is about 125 million.
Great. I believe Brad was next.
Thanks, Christy, and thanks for Croatan and Vertue Lab inviting me into the discussion. I'm a managing director and partner at a firm called Tiedemann Advisors. We manage about $25 billion for foundations, endowments, and high net worth individuals. We're officed in 9 locations in the US, as well as an office in Zurich in Switzerland. And ESG and impact investing, which is the part of our business that I oversee, has been a rapidly growing segment of it for all of the obvious reasons that we'll talk about today. So I've had the good fortune of partnering with Kathleen and Eric over the last 7 or 8 years on transitioning both of their foundation portfolios out of highly carbon intensive industries and into the sectors that we think will benefit in the years to come.
Thanks, Brad. And now we'll turn to Mike. Oh, you're on mute still.
Apologies. You figure after 6 months I'd have this figured out. Hi, Mike Lear, Senior Vice President and Portfolio Advisor at Capital Group. For those of you who aren't so familiar, Capital Group is a $2 trillion asset manager with 12 offices around the world and across the United States. We employ over 300 analysts and have about 14,000 or so company meetings. But what brings me here today is, we started this company in 1931, and the area where I work in private client services started out as a family office in the 70s. And since that point in time, we've been trying to create superior long-term results for our clients. And more often than not these days, that means identifying companies that are well positioned for the future and those that are sustainably able to grow their businesses and also be strong corporate citizens at the same time. So we're looking through and analyzing the environmental, social, and governance considerations and trying to bring forth the most productive portfolios and the most aligned portfolios we can for our clients. So happy to be a part of the conversation, and hopefully I can add some points of value. Thanks.
Yeah, great, thank you. And Eric, you're on mute still.
Yeah, you'd think I would figure it out since I'm spending about half my life on Zoom lately. Thank you, Christy, and thanks everybody for being a part of this today. I think the question was, where am I coming from? And I was going to give the pseudo snarky answer. I'm coming from Portland and my backyard, but more to the point, my family and I have been very fortunate to start a philanthropic venture with the assistance of my dad, who died about 24 years ago. And the advice I give friends, which I mentioned sort of in a humorous context, is if you win the lottery, don't start a family foundation, because it tends to bring up all the issues in the family that are sort of simmering there, when you're together at Thanksgiving or whenever. And when money is involved and the management and, the ability to do good with the money, it inevitably involves values. And so I started a conversation in family, which eventually, after a number of meetings and a number of, it did bring up those disagreements in the family. Eventually, we got to some consensus, and then we were really lucky to meet Brad, to make the acquaintance of his firm, and to switch to folks who really cared about this subject deeply. And so I will say that, we continue to be very fortunate to work with folks who care deeply.
That's great. Thank you. Well, I think it's interesting that both the Lemelson Foundation and the Russell Family Foundation are Pacific Northwest-based foundations. We have very different missions. Eric, the Lemelson Foundation is more focused on thematically on innovation and invention, while Kathleen, the Russell Family Foundation is much more of a place-based, regional focus on community. Could you both speak a little bit about, more about, the guiding mission of your organization and how that played into the commitment from your organizations to decide to commit to this divest, invest pledge, and what that process sort of felt like or looked like at your organizations?
Kathleen, you want to go first?
Sure, and I'm going to put a clause on this that the actual signing up for the divest invest was before my time at the foundation side of the house. And so I'll share a little bit about our mission and how this aligns with what we're trying to do in the world, aligning all of our grant capital alongside of our investment portfolio. But Brad was really in the driver's seat as we began this process. So I'll turn it to him to share some of the challenges. The Russell Family Foundation is a place-based foundation. We were founded in 1999 when George and Jane Russell sold Russell Investments. And they have a real deep commitment to the Pacific Northwest, and particularly the Pierce County area. Eric, as you mentioned, it's a family foundation. So what are some areas that families can come together and do investments that they all align on with the same values? So the areas that they chose were the waters of Puget Sound, environmental education, and we also run a grassroots leadership program in the Pierce County area. So when we think about what tools we have available to us and in our investment portfolio, divesting made perfect sense, because if we're granting for the health of Puget Sound and we also have oil and investments in areas that are actually causing water harm, that doesn't make sense. So it made sense for us to divest and then take those investments and actually invest in areas that improve the health of Puget Sound and the Pacific Northwest. So Brad, do you want to share anything about the process that we went through?
Happy to. And this was back in 2013, 2014 timeframe when we started along this journey. We were originally focused on divesting of the Carbon Underground 200, which comprised coal, oil, and natural gas. But what we quickly learned is that some unintended consequences could come about if we were simply to take a linear divestment path and divest of just the fossil fuel industry. And what I mean by that is we could unintentionally over allocate to other areas in the public markets that are highly carbon intensive. So metals and mining, basic materials, utility companies are actually 3 times more carbon intensive than the fossil fuel energy sector. So what we did early on, and we did this with both the Russell Family Foundation as well as the Lemelson Foundation, was bring in a third-party scientific research group to do an initial carbon audit of the portfolio. And then we continually assess the carbon footprint of each foundation's portfolio as we've gone through the divestment journey over the last 5 or 8 years. So what we've done is we removed all exposure in both foundations' portfolios to oil, gas, and coal, but we've also eliminated anything else that's highly carbon intensive in the portfolio. We then overweighted to clean tech and sustainable real assets in the private markets. So we'll get into, I think, a few of the investments a little bit later in the discussion, but I think looking back at it, sort of having a broader focus on reducing carbon footprint and getting out of the other highly carbon intensive industries as we were divesting of fossil fuels was the most strategic lesson learned.
And Eric, do you want to?
Sure. The Lemelson Foundation was founded by my dad with the active participation and support of our family. My dad was an independent inventor from the time in his 30s when he literally woke up one morning and said to my mom, "I'm not going to work today." And it was May, the year that I was born. I believe my mom was pregnant slightly. And the weather was nice. This was on the East Coast. And my mom said, "What do you mean you're not going to work today?" He said, "I'm an inventor. I'm going to spend my life doing that." And, I wasn't around for that moment, but you can imagine in that time, men who were typically thought of as heads of household didn't typically do that because it added a kind of perpetual note of income insecurity into the family. However, he was smart enough to have picked my mom as his partner, and my mom was an interior designer and supported our family for many years after that day. Bringing that more to the present, the focus of the foundation is on, it's really multifaceted because we started as a US-based, to the extent we can talk about place, we were focused on the United States simply because my father was somewhat of an economic nationalist, and he saw the importance of invention and innovation and entrepreneurship to the American economy, to our ability to support a standard of living that provided a good life for a lot of folks. This is in the post-World War II era when we had a strong middle class, when we had policies that supported that, and when, this was a period during which the economic leadership and preeminence of the United States was called into question by competition. Not that different from the period that we're in now, except on the leadership side now, I would present that our leadership is not up to the task. But we won't talk about politics today, right? I'm going to just quickly summarize by going to the website. What you get when you open to lemelson.org is two phrases. Invention has the power to improve lives. It's kind of a duh moment. We believe inventors will solve our biggest challenges and improve lives in communities in the US and around the world. At a point a number of years after my dad's passing, my brother and I, who had traveled widely, especially in the developing world, realized that there was a lot of work to be done in the developing world in terms of bringing to the fore the importance of invention and innovation in countries and cultures that had not had the good fortune to have the American experience, both in timing, natural resources, and leadership. And yet what we realized early on is that innovation is not limited geographically. The ability to create and innovate is a global ability, and it's found in all cultures. It may not be found in all places at all times, but the nascent ability is everywhere. And we've demonstrated that. I mean, another duh moment, it's once you start doing the work, making the grants, meeting people, it becomes really clear that people globally want to have the ability to engage in innovation if they simply can have a system that supports those kinds of choices, both in terms of the economic system, the politics and policy, and the education, especially. Education is a critical component. And so we have focused a lot of our efforts on invention education. That was not a term that was in use 25 years ago when we started. It is becoming fairly widely referred to these days, especially in the US. And we support a lot of programs that do that work. In the developing world, we started with the assumption that the fundamental benefits of invention and innovation are spread broadly, and that while it may not be easy to go into a developing country and find the players, find the institutions, find the ways in which we can participate, it's vital work. And we've been doing that since about 2002. On the investment front, it became obvious, as I referred to, that it was, there was an awful lot of good stuff that could be done by focusing on the enormous pool of money that we were fortunate to help manage. And so, starting about 10 years ago, I can remember, making a reference to a specific firm. I was a personal investor in Generation Investment Management, Al Gore's firm, and there was a lot of skepticism years ago. What does Al Gore know about the world of investing, money management? Well, it turned out the worldview that brought Senator Gore, Vice President Gore, and now Citizen Gore to the world of money management is the same value set, the same recognition about the work we really need to do, focused on climate and corporate behavior, and that you could find companies that get it, and that, in fact, in the corporate world, that's exactly where a lot of effort needs to be made, because that's where a lot of the leadership is. That's where the ability to innovate and create is now centered. And, much to my pleasure, I guess is the way I would say it, there is increasing evidence that that's the place where a lot of effort will bear the results. And so over time, it's no longer a secret that this approach to investing yields both good results in terms of performance, and also the ability to not just stay awake in money manager meetings, but feel good about what we're doing. And yeah. Christi, you look like you're about to ask a question.
Yeah, no, I wanted to hear a little bit. Now, I think that makes a lot of sense. I wanted to turn to Mike for a minute and ask, Mike, you've been engaged with Croatan Institute for several years. You've spoken with on some of our other Clean Portfolio Project events. But when we first started engaging, you were working for an independent multifamily office, which probably had a lot of flexibility and discretion to go, off the grid. But now you're on the advisory side of one of the largest asset managers in the world, like as you described. What's it like to work from this platform, and how do you get involved in helping nonprofits, foundations, and families deal with these issues and think about, deal with the things that Eric was describing?
Yeah, so I'll start with the second question first, I guess. And so why clients are coming to me generally and coming to Capital Group is they want our experience. So, right, they want my 20 years of experience in the industry to kind of guide them, because we don't always have the benefit of having somebody like Eric or Kathleen that's, pretty far along their journey. We've got to meet with a large range of clients. So I would say they generally come in three different buckets. There are folks like Eric who seem to be greatly involved in the portfolio, what they'd like to see, and have some idea of the direction they'd like to go in. But those other two categories of clients, or some are sitting in the middle, they've kind of started on their journey, or some are at the beginning and they need some hand holding and they need to really think about the process. And that's where I come in and people weigh on me to kind of, for foundations to come up with an IPS that really describes how they'd like to move forward, what's important to them, what sort of metrics they want to report on. Things that seem simple to folks that have been involved for a while, those aren't always locked in and understood. And there's also this problem we have globally as an industry. We haven't settled on one set of reporting. We haven't settled on the one set of language even. So what may be impact to one may not be impact to all. And so you've got to just be really clear. And that's my goal, to hopefully ask good questions to tease that out of clients, and then reflect that back to our portfolio management analysts. Because we can have all these great, I talked about our 14,000 meetings. That does you no good if we're not gathering the information that you need in your specific portfolio at a specific point in time, and make sure we're meeting your needs as a client. Because a lot of what we're doing now is customized work for larger clients who are interested in this space and who want to make sure their portfolios are aligned. The other thing that's different, and I'm not sure this is different for me working in this particular firm at this point in time, but a lot of clients are looking for alignment from us as investors, as an asset management firm. So they want to hear about what we're doing to be better corporate citizens. And a lot of times we'll talk about, our largest office in Irvine, California. We've got solar panels that have been providing millions of kilowatt hours of energy. We're trying to offset. So all that travel that we used to do, and we'll get back to hopefully sooner rather than later, all that carbon that we're releasing, as I'm going to see clients, as our analysts are going to see companies, we're trying to offset that through investments. So clients, they come in many different shapes, sizes, and places within their journey, but they're really getting a lot more questions about us, about me personally, my experience, but more broadly about Capital Group and what we're doing. And then we have where the rubber meets the road is actually the investments of portfolio, which right now is probably the easier part of everything. So with that in mind, we're creating, almost 30 different sector frameworks, because, something Brad alluded to earlier is if you look at the MSCI world, 80% of the emissions come out of 3 different sectors. So having those sector frameworks gives us a common way of speaking and conversing with clients and reflecting back and making sure that they're getting what they want out of the portfolio. So whether that's job creation, reductions in emissions, we're really clear about that. And the last thing I'll say is when it comes specifically to fossil fuel divestment, you really want to be clear with clients where they are on their journey on a couple different factors, because when you remove those largest, fossil fuel producing companies, you end up, if you're using a broad index like the MSCI World, there's a mismatch between the capitalization weight of those companies and the weight of your portfolio. And where that rubber meets the road is when we're having conversations, we've got to remember those decisions we made, why we made them, and why we might not always look like the portfolio. And then also on the back end, make sure we're reporting back and we're aligned. So, I might sound like a broken record to most of my clients, but, every quarter or more often, I want to be talking, make sure we're speaking to the IPS, make sure there's been no changes within the foundation or within the families that I work with that would cause them to do something differently. And then also make sure that they understand why we are where we are at any given point in time. So we're actually maximizing the hour we have with clients to really focus on goals.
That's great. So Mike, you just mentioned the IPS, which maybe some of our listeners tuning in might not know what that's the investment policy statement. Yes. I'm curious, with the 2 foundations here, what role did your investment policy statement have the language, the ESG or environmental, social, and governance factor language or climate language before? Did you add it after taking this pledge to divest and reinvest in climate solutions?
Eric, you want to take that one first?
Yeah, I don't think we actually have changed anything in terms of statements. We're actually talking at the moment about updating the website and including a broad statement about values. What are our values as it relates to the work that we do? And so I think I can make that a short answer by saying I don't believe we have changed anything because I'm not sure we had much to start with in that sense.
And I'll have Brad jump in also, since he was part of that IPS development. In our IPS, we don't have an explicit climate change language in there, but what we do have is that that we are to invest with mission alignment without financial return concession. But also we have a portion of our portfolio that's called the aspirational portfolio, that we are investing for mission regardless of asset class or strategy, without regard for the financial return, but really for the high impact that we're investing for. But Brad, is there anything as you developed the Divest Invest, the IPS development at that time when you were a part of the team?
Yeah, we started out along the journey that was first focused on the divesting of the 15 dirtiest coal companies that were out there, the dirty dozen, or people call them different things. And then we moved into the oil sector, and then we moved into the gas sector. And then we essentially did the rest of the strategy on lowering the carbon footprint by getting out of those other highly carbon intensive industries. We're very explicit with our investment managers on where we don't permit them to invest. So that's within fracking and tar sands, companies with large stranded assets, energy equipment and services companies, sort of all of the language that you would expect to be incorporated, whether it's within an investment policy statement or whether within an explicit management agreement with one of the underlying investment funds that are allocated to.
So I'm interested in hearing more about the foundation's decision-making processes around investing in the endowment. So how do you find or decide which climate solution investments to invest in? I kind of outlined a whole list of types of climate solution themes. And of course, during the Fuel 2020 conference, we've been talking about a lot of different great clean tech innovations. How do your foundations or your investment advisors help you find these, things that you, or is it kind of values oriented, or is there a thematic decision making that happens inside the board or the investment committee?
I guess I can jump in and say that we have historically followed Brad's lead. Brad knows the values. I have regular conversations with Brad, both about my personal portfolio and the foundation portfolio, and he pretty much knows where we're coming from. He will regularly test the waters with new products or new themes and see what the response is. But in general, we've been increasingly open to new approaches to doing what we're doing.
And building on that a little bit, we go through annual surveys, or when new board members come on, or when the next generation of family members are engaged in the board. So we'll go through and continue to update this strategy. As you can imagine, there's just been tremendous growth in the ESG and the impact space. There's a product suite out there today that didn't exist 2 years ago, that didn't exist 10 years ago. So we're always trying to enhance the quality of the impact in the portfolio. Where we specifically focus is, ultimately our thesis here is trying to reduce greenhouse gases per $1 million invested. So largely CO2 and CH4, carbon dioxide and methane per $1 million invested. So in the private markets, where we think we can have a significant amount of impact, is we're focusing on really two different areas. One is clean tech. So that can be anything from solar and wind to energy efficiency to really interesting artificial intelligence solutions for climate mitigation. Within all these strategies, this is sort of the concept of the negawatt. We're able to reduce the CO2 and methane that's emitted by the portfolio, but we're unable to essentially sequester it outside of some technology investments that we've made in the space. So the second area we focus on is sustainable real assets. And both foundations have done some significant investments in sustainable forestry, regenerative agriculture, ecosystem service markets, which looks like carbon trading and other sorts of wetland mitigation, banking type strategies. So those are the two areas of focus. There are a few other areas that I think, looking out into the future, will continue to offer some really attractive investment opportunities. The one I'm seeing right now is within the plant-based proteins and alternatively replicated proteins for mass food consumption. That's driving significant greenhouse gas emissions all over the country.
And at the Russell Family Foundation, very similar to Eric, we do rely on our Tiedemann team quite a bit for the broad portfolio, and they do bring the recommendations to our investment and audit committee, who will then review those and approve them. I also, in addition to the Tiedemann team, am consistently scanning opportunities through our networks and supporting organizations such as Confluence Philanthropy, Mission Investors Exchange, SOCAP, and also peer foundations. We belong to a network of peer finance and investment leaders from foundations in the Pacific Northwest and Hawaii called Canopy. We meet regularly and share information on investment opportunities, and we help each other in a community of practice and just to source and to just be able to think of what are the opportunities to really dive deeper into the quality of investment in our portfolios.
So one thing that came up in our study and something that we've been working on for a while at Croatan Institute, in 2016, we wrote a paper with Divest Invest Philanthropy, an earlier paper that was describing the evolving landscape of investment opportunities that finance solutions to climate change, but explicitly have positive community impacts. So I'm curious, do any of your climate solution investments explicitly integrate social impact or community investment? Our study identified about $1.6 billion of this sort of community-oriented climate solutions across asset classes. So the question was, do you make an effort to link the climate solutions with the social impact that they're having? So I know that I think we might have actually highlighted the Russell Family Foundation at the time, and like, for example, Craft 3 and Eco Trust were two investments we talked about that bring community development and environmental sustainability together. So I'm curious, how do you think of those things? Is that, is that something that you would explicitly look for, or are you just, yeah, I don't know.
I'll say, for Lemelson Foundation purposes, that we have diversity of opinion on the board, and at least one and probably two board members are really focused heavily on community activism and community-based solutions, which would incorporate what you were referring to just now, Christi. And I think more holistic solutions are always more interesting than narrowly focused, renewable energy plays, of which there are a lot more than there used to be. And we also realize that, you mentioned EcoTrust, and one of the things that was interesting about EcoTrust way back in the day is that they were taking a very broad look at how they define community. It's not just the economic interests and that narrow slice, but what are the downstream impacts, for example, of a transition out of forestry as an economic activity? There's a net positive from getting out of rapacious forestry, corporate forestry approaches that ruin the environment, that ruin the community, and that the only thing that they do is enrich a very small number of people who happen to own the businesses or shares in the businesses. Whereas EcoTrust was taking a very different approach that looked at, how do we slowly regain the health of these communities in the Pacific Northwest that put all their chips on, on timber production. And as a result, years later, when the companies leave the region and go towards the next region that they can rape and pillage in, they're left with nothing. They're left with no education system. They're left with massive social problems and the lack of health insurance, you know, virtually guarantees all sorts of horrible impacts visited on the residents of the region. And that's what you find when you get out into communities in the Pacific Northwest and get away from the, you know, the positive urban stories about, you know, groovy Portland and Seattle. You find places that have been underinvested in for generations. And one of the things that was super positive about EcoTrust to me was that they were looking at, you know, how do we regain the health of these communities by focusing more broadly than just on the one narrow slice, which is important, but not the picture. So.
Yeah. A question came in actually that reminded me that the Vertue Lab session right before this one was focused on climate justice, and the panelists seem to agree that we can't make meaningful climate impact without addressing climate justice, especially the impacts of climate change on racial minorities. Mike, I know that, I mean, you're on our Croatan Institute's Racial Equity, Economics, Finance, and Sustainability Initiative, or REEFs. I know we're united in the concern that renewable energy revolution underway should not leave frontline communities, especially communities of color, behind. How do you integrate racial equity and environmental justice into these sorts of climate solution investments?
So I think this ties back to one of your early questions about how different it is working at a large organization. So I'll take this a couple different directions, but the first, and I think the broadest, is we really use our seat at the table as one of the largest active investors in the world to encourage companies to do the right things, and also use our weight as investors to actually allocate more resources to those companies that are doing well by their consumers. So, you know, I can't mention specific company names, unfortunately, in this context, but if you look at one of the largest US manufacturers of farming equipment, for example, we're overinvested or have a higher weight than others, and a company that is leading edge technology and machine learning to enable precision farming and reduce fertilizer and herbicide use by 80 to 90%. So what does that mean? In developing countries, that means more food security, it means lower emissions, and it has positive knock-on effects, third and fourth effects, by way of investment. You know, another area where we're kind of over-investing or taking a positive approach to is there's a large food retailer based in Europe where they're looking to reduce all of the waste within their company. So this particular company wastes only 1 in 6,000 items compared to about 3% for the industry. And they do this by using a state-of-the-art warehouse system. So, you know, if you look at those two examples, you're lowering food waste and lowering food insecurity. We use those as kind of positive responses from an investment perspective. And taking the other angle of your question, and part of the reason why I participate in REEFs is to make sure that, you know, I have a seat at the table when decisions are being made. And this largely is reflective of what we're doing in HR, bringing folks into the company. Women and minorities are particularly underrepresented in financial services. So there's a number of different ways. I can do it by doing a great job, and hopefully they hire more people that look, sound, and like me. But we're trying to, we've created internally a pathway towards making sure, you know, we're talking to HBCUs about the historically Black colleges and universities about creating pipeline for people in financial services. Me and my particular practice, I've gone out of my way to encourage investment of minorities and for women, and not only in public market investing, but also in private equity, and making sure my clients are over allocated there. So, you know, aligning not only what I do with what I say and what my clients are hoping and looking to do, but also just making sure we're walking the walk.
Yeah, and Brad, I want to turn to you as well to respond, but I want to also shift the conversation to think about how your investments in climate solutions, you know, for both foundations and other clients are using that total portfolio approach you talked about, and that we also talk about across our asset classes. And if you could kind of give us a high level, and I'll ask Mike to weigh in as well, in terms of what kinds of opportunities in climate solutions you see in different asset classes, from fixed income, real assets, private equity, public equity. And because of time, I want to add, there's one person asking a specific question. How do we get more patient capital flowing to inventors of climate tech solutions that have longer gestation cycles than some or most VCs can stomach? And so that comes to the question of, these different asset classes have a purpose. There's different ways to invest in solutions. So you can respond to that first.
Sure. Yeah, I think there were a couple of questions in there, and I applaud the work Mike and Capital Group are doing on incorporating diversity, equity, and inclusion. It's the area that I'm seeing have the greatest interest in our space. It's environmental sustainability and diversity, equity, and inclusion, and particularly the intersection of those two, as there's a huge amount of capital that's being shifted from one generation to the next, particularly in the US right now. In terms of opportunities across asset classes, I mean, if you think about US equity markets, there's increasingly sophisticated tools out there to be very specific on how you seek to divest and then over allocate to low carbon businesses. And that can still be done in the passive equity markets. Within the actively managed global equity and US equity strategies, I think probably the most compelling or impactful approaches are going to be those that Mike described in there, where management teams are doing a very specific direct shareholder engagement to change corporate behavior. We're seeing a lot of that. I mean, it's sort of the counter argument of divesting is you're sort of losing your seat at the table if you choose to divest of those assets. So how can you change corporate behavior through public markets and shareholder advocacy? And then within private markets, I touched on a few of these, but increasing opportunities within food systems, we're seeing a lot of that. We're also seeing interest and opportunity in the oceans, in the blue economy space. And then we're lastly seeing quite a bit of sort of big data, machine learning, artificial intelligence for climate mitigation. Perhaps a fourth one on there would be if we have a change in administration, or even under the current administration, there would be a significant amount of investment in infrastructure within the US, upgrading existing electricity transmission lines. And you can see the opportunity there for private capital to move into electric vehicle charging stations, batteries, power, rooftop solar, all sorts of things related to that.
So another question has come in asking about private investments. Do Lemelson or Russell or any of your clients look directly at private companies as part of a portfolio strategy? And how can investors encourage the growth of emerging companies? Of course, this is a clean tech incubator at Vertue Lab and Fuel 2020. So how do we encourage that growth for emerging companies and the next generation of potential public equities?
Eric or Kathleen, do you want to describe any of the private investments that you've done, or I could make a plug for Vertue Labs investment strategy?
Yeah, I would just say that as an individual investor, I made some interesting choices 15 years ago when renewables, was the next wave of renewables and companies were getting off the ground, and I made direct investments. Actually, took a board seat, requested and got a board seat on a thin film photovoltaic company, and lost my shirt. Learned a lot. I don't know that I would do it again today, because I learned of the difficulties of a non-technical person like myself, who has some grasp of the science, making the right choices in terms of where to invest and how to invest. But I think what Lemelson has found, and I would actually defer, Brad, to you on the details, is that if the money is pooled and part of more of a group effort, it takes some of the risk out. And in some cases, we may want to be funding companies that are a risky bet because other players may avoid those spaces. and leading to a problem of, we want the technologies to succeed and be scalable and hit the market and have impact, but we're not willing to put the money up because there's a risk involved. And, foundations historically have played a limited but important role in de-risking opportunities at certain points in the investment cycle so that companies can survive and continue and get money later on once the risk profile has changed and it's become obvious to more standard investors in the VC world where to place chips. But Brad, I'm sure you have more to add to that.
Yeah, the Lemelson Foundation does quite a bit of private markets investing, with about $80 to $100 million invested currently in the private markets, and the Russell Family Foundation has about 15 to 20 million invested in private markets. So both are experienced in that space. Both foundations also do sort of practice this integrated capital approach, where we have mission-related investments out of the endowment, we have potential program-related investments, and then we also, the foundation staff has the ability to grant capital, and those can be done oftentimes simultaneously into the same investment strategy to de-risk it or to provide a first loss provision for other investors to encourage coming into the strategy.
Kathleen, did you want to describe some of the investments that you're particularly excited about that the Russell Family Foundation has been pursuing?
Yeah, happy to. And from our perspective too, on the direct investments, we are a small staff, so we do tend to shy away from the direct investments just because we don't have the capacity. But just as Eric said, that's where we can be catalytic. Philanthropic dollars are to be catalytic, and how can we help, especially in inventions, how can you create change with philanthropic dollars and change that risk profile? When we think of some of the investments we have in our portfolio across the different asset classes and fixed income, we have a septic loan fund, which is a loan fund that actually provides low income or low interest opportunities for those septic tanks that might be failing in our Pierce County area. They're able to get a loan that's at a low interest rate. So we're helping the health of the water in addition to providing a fixed income product. We also, as Brad said, we are invested in EcoTrust Forest. We also use, when we think of total portfolio activation, loan guarantees. We just recently did a loan guarantee to a nonprofit to be able to secure a salmon saltwater estuary for salmon hatcheries. And so being able to use those tools across the entire portfolio just helps us to help increase the health of the water, which is what our mission is. And as Brad said, being able to use each one of these in either individual or stacked capital is really an interesting way and a fun way for us as the foundation to be able to have impact with all of the tools.
So we mentioned earlier in the report, we've heard that 94% of the respondents to our survey said that they had financial performance that was equal or better than they had before committing to the Divest Invest Pledge. So I'm curious what your experiences have been. And in addition, if you've had challenges investing in climate solutions, what are those and how have you gotten around them? Similarly for Mike and Brad, of course, your clients, how do you approach that? So I'll go around again. How about Kathleen? Let's start with you again.
Because I'm off mute. So, if we look back at 5 years, our return on the 5-year return it's just about 9%, with our blended benchmark being about 7%. So since we've done the Divest Invest, we actually are seeing our portfolio beat our blended benchmark by about 2 percentage points. And year to date for this year, we're at about 6.2% total income versus 3.8% in the benchmark. So for 2020, we're beating the blended benchmark by a little over 2%. So we're really seeing that the divestment has actually helped catalyze the performance in our portfolio.
And before we continue, actually, there was a question that had come in on the HOVA app as well, and kind of relating to the COVID-19 impacts and the destructive weather events that are affecting the whole West Coast right now. And do you see kind of that impacting, you know, in a positive or negative or neutral way, the way that the foundation's results have been.
Well, I'm going to let our investment advisor provide their feedback in the current market thinking. We are actively watching it, considering today what's happening in the markets too. And really, you know, we do have a lot of sustainable forestry. So I've been actively watching all the reports that are coming out from our forestry holdings and just, you know, keeping tabs on what's happening with them as well. But Brad, if you want to provide your thoughts on that question as well.
Sure, and the COVID crisis has really exaggerated what's going on in the stock market versus the real economy. So the stock market is at near all-time highs, whereas, you know, we're at huge amounts of unemployment. We've got the virus spreading rapidly, forest fires up and down the West Coast, tropical storms in the Gulf. I mean, it's just social unrest in the streets. It's interesting that the financial markets are performing so well, but as a result of divest, invest, and the decisions that were made sort of pre-pandemic has actually played out to the positive on a financial returns perspective for both of these organizations. It's you know, they've been outside of the energy sector, which was by far the hardest hit, down 25% year to date. And then they've also been outside of any of the highly carbon intensive industries. So beyond the ones that I described earlier, they've been also outside of, say, casinos and airlines and other sort of highly carbon intensive manufacturing, which has been, you know, extremely depressed during this time period. And then the overweights to biotech, healthcare, and information technology, which are up to the tune of 40%. So you're seeing about a 65% dispergence between the bottom and the top of the market.
And Eric, how is the Lemelson Foundation fared since committing to divest, invest? And I know you started that work even before pledging in terms of returns.
Yeah, we are. I'm famously disorganized today because we just had our board meeting and my papers are scattered all over my office here. So Brad had just sent me summary of returns, which is somewhere in this pile. But I took a quick look at it. As I already knew, we are performance is substantially ahead of the benchmark. Not depending on which time period you look at consistently. And I will say that, you know, one of the primary hurdles for impact investing used to be a perception that it was riskier, that you had to accept reduction in performance, that you were basically sacrificing to do some nebulous good. You were going to sacrifice in all these different areas. Well, guess what? The world has fundamentally, what has been changing as it always does. And on a fundamental level, I would put forth the rather obvious position that the risk profile of the old economy, a fossil fuel-based economy, where the fossil fuel industry occupied such a huge part of all the indexes, that's where the risk is now and going forward, because it's not just the risk of price fluctuations in fossil fuels, but the very real risk of stranded assets, which the investment community is now starting to take a very hard look at. The idea that you have this immense amount of stuff in the ground and all you have to do is dig it up and get it to market and you'll make gobs of money. Never mind the fact that fracking has always been somewhat dubious economically because of the costs associated with it and the fact that the price per barrel of the product has to be X in order to be even modestly profitable. I'm sure we've all read analyses that fracking actually is not profitable, but that it was a place to put an enormous amount of capital during a period of low interest rates and, and no performance on the fixed income side, blah, blah, blah. So what I'm saying ultimately is that fossil fuel economy has its own set of risks. We were very fortunate, Lemelson Foundation is, to say we were fortunate to make this transition before all of this became uber obvious a few years ago, and we rode the wave and avoided the losses when fossil fuel prices, especially oil prices, took a huge dive. We were never, I don't think we were ever heavily invested in coal companies, but you look at the performance of coal industry stocks, and the last time I looked, they were down between 90 and 95% over a period of time. That's not a very good performance record.
Right.
And I think we will look back at this period as a transition period. Ultimately, it's not going to be, I don't think it's going to be a period where we go back to what was, with a brief period in between where we're all patting ourselves on the back. I think this is a time for cogent and smart analysis of where things might be going, and choosing companies to invest in, and then I'll shut up, that across the board are behaving in ways that we can get behind. Yeah, because those are the companies that are going to do well.
Mm-hmm. I'm curious, Mike, how your experience has been with your clients, and are you seeing similar kind of misconceptions that getting out of fossil fuels are going to hurt returns, and how do you deal with that?
I'm over here smiling because both Eric and Kathleen are very much on the same page, it seems, with their advisor, where oftentimes I have to play bad cop. So when you've got a board, not necessarily with a family foundation, but I've managed money for several large endowments and high schools and colleges. That's where it becomes particularly challenging. But the interesting silver lining of the current environment with all the fires that are going on and with all the climate change that we're seeing actually in action, you have people's attention now, and they're asking the right questions. And they want to see more alignment of their portfolio, and they're a little bit more hesitant to fall back on, oh, we're going to sacrifice returns. Because that we can pretty much say demonstrably that that's an incorrect way of looking at things now. You can show them the performance of the energy sector over the last decade. That's one area where you can look to and just say, hey, look, if you had done some other things that were different in those areas, you could have probably outperformed. And also, now we're seeing actually from the other end of the spectrum, if you look at the S&P 500, the top 5 companies, top 5 tech companies are now 25% of the index. So it is a great place and time to be for fundamental active management. So we can say, hey, look, you can have your cake and eat it too. We can take away all these things that are not aligned with your long-term goals, bring you a portfolio that's more aligned, and hopefully achieve returns that are as good, if not better, than the index. And we can demonstrate that over time. So I think, despite all the negativity that's going around all over the place, the one silver lining is we've got folks' attention, and more importantly, people are willing to move. So as before, there might be long, ongoing conversations that take, in the case of a foundation, could be over a year. Now they're saying, we want to see different things now. And a separate but related example is when we had some of the large mass shootings. People wanted to be divested from weapons manufacturing. So it was in that moment, and especially during the Parkland shootings, where people just said, hey, look, enough is enough. We don't want to be invested in these areas. And now we're seeing that same sort of seminal moment on the environmental front, which is one of the only silver linings of the current environment.
Thank you. Well, we're going to have to leave it there. This has been a great conversation. I see that we're at a quarter after the hour. I don't know, I believe Kristen was going to join us, but I want to thank Eric, Kathleen, Brad, and Mike for joining me to talk about how we can mobilize philanthropic capital across asset classes into climate solutions. I just want to note too, we're hoping to have future work with, we are working in the Pacific Northwest and hope to continue collaborating with Vertue Lab and some of the work we're doing around regenerative agriculture and forestry, and have an upcoming Croatan conversation next month on sustainable forestry and finance. So please check out Croatan or CroatanInstitute.org to learn more about that. But thank you, Kristen.
And thank you, Christi, and all the panelists. It was a really fascinating discussion, and I really enjoyed it. We want to thank Croatan Institute for being our partner and for helping us put this together, and Christi for moderating. And then we also want to thank our title sponsor for the Fuel Conference, which is Bank of the West. And tomorrow, if you're interested, we will have our 5x5 Clean Tech Company Showcase, where you can hear short presentations from 5 entrepreneurs that are actually advancing some technologies that you may be interested in investing in for fighting the climate crisis. And you can find the link in your Whova app. So thank you all for joining. We really enjoyed it, and we hope to hear from you soon. Thank you.
Thank
Thanks
you.
for having us.
Take care.